to become better traders. So yeah, so today we're talking about stop loss and exiting trades. Welcome to see more people joining. Welcome all. So we'll talk about that elusive stop loss, how to exit trades. Then we'll don't leave just yet. Afterwards, we'll talk about give you 7 quick bonus tips, and you'll have time to ask questions. So quite a bit of material to cover. And before that, I'll just talk about the premium section. We help you trade with confidence, stay focused, disciplined, trust your method, identify the best market opportunities, execute your own trading plan. We'll talk about that today a lot as well, and train you to be that professional trader you want to become. Tomas Sayas and myself, we're leading the content part of the team. We'll guide you through your trading journey, provide in-depth analysis and strategies, and provide also webinars like this one. You can also see recordings. This one is open to the wide public, but most of them are not. You have to be a premium member. We have a new functional dashboard developing it all the time, adding lots of bells and whistles over there. And we're giving you direct access to ourselves, to the analysts. You can ask questions. We recently launched this, what you see here, Discord channel, and we had lots of success with it. So anyway, I think the premium service is great. Well, of course, I'm biased. But anyway, I'd like to invite you to sign up if you're not a member yet. So here I put the link in the chat. And that's my pitch for today. It wasn't too long, not too painful, not as painful as stop loss points. So yeah, let's kick it off. So I'm sure each one of you who has been trading for once at least, you've suffered from your currency pair hitting the stop loss point and then moving in the right direction. So you went long, and at pound dollar dip did a sort of even flash crash and then moved to the right direction. So first of all, take it easy. It happens to everybody. It'll happen to you even if you become an expert professional, even if you make trading your living. So just well, try to take into account that that's what happens and you need to deal with it. Okay. Now, if you're what I recommend you not to do. If your broker is regulated, don't blame it. Usually the broker is not trying to cheat you. I mean, it's very rare that the broker is trying to cheat you if this broker is regulated. Don't try to blame the broker, analyze the trade. Yeah, don't try to take revenge on markets. Don't do this, punch the computer on the screen. It will not help you win money. It will not help you learn, okay? Other things not to do. Don't risk too much. You need to have the opportunity to learn. So if you failed, sorry, not using the right word. If your trade ended in a loss, and that happens even to the best, and we had the opportunity to speak to professional traders, they know how to lose. They accept it, okay? But they have more spare capacity to learn. So you have to be able to lose. And please don't put mental stops. For those of you who don't know what mental stops are, maybe I shouldn't tell you what they are. What the basic thing is, always put a stop loss point, okay? So these are the do's and don'ts. And yeah, and the idea is to stop losing. I mean, stop having these losing streaks. It means taking a break from markets. It helps cleaning your head and analyze what happened. And I'll already say now, it's important to analyze what happened also in winning trades. So to balance things out, okay? If you had a losing trade because it hit your stop loss, don't get depressed. If you had a winning trade, don't get euphoric. Everything needs to be a bit more level-headed, okay? So when you hit your stop loss, what happened? Check out what happened in markets. Did an extreme one-time event happen? Did a war break out? Did the Fed say something totally unexpected? Was it really something totally out of your control? Then my advice is just sit back and do nothing. This was an extreme event. Your system probably works very well. Nothing to change here. These things happen, okay? Okay. Now, has market volatility changed substantially? Then, okay, widen both your stop loss points and your take profit points, because now we're trading in a different environment. We have more significant moves to the upside and to the downside. Means you can make more money, but also lose more. So lower your the amount you're putting on the table, the position size, but you can widen the stop loss so it won't hit it, but also widen your take profit because overall volatility has changed. Okay, now was your stop loss too tight? You must be thinking that if it hit that stop loss point, right? Then why? In general, try to ask these why questions to get to the bottom of things. Did you adjust it to meet your risk reward ratio? That's not a good thing. If your take profit was that you felt confident with was relatively small and just wanted a good risk reward ratio and you squeezed your stop loss point and became too tight, then this sort of this trade was totally wrong. We were just overconfident. You said, I'll put the stop loss here because everybody in Forex courses tells me always to put a stop loss, but it won't hit it. If you were too confident, again, time to reassess everything. And in any case, these are cases in which your trade hit the stop loss. Let's see how we can improve them. I'll give you a few tools. Hopefully, they'll help you develop your own method. Okay, so look at the charts. Check out previous breakout of the range. And this applies, let me say, even if you're looking for trading the range, and I think most of you are more looking for breakouts. Anyway, check the previous breakouts out of ranges. Look for clear ranges, okay? Clear areas where the currency pair in your selected time frame trades in a very stable range. Okay, what consists of a minor deviation from the trade, from the range, sorry? Was it 2 pips, 5 pips, 15, 20 pips? Some crosses like pound yen are crazy. Some are very boring. Pound dollar is more volatile than euro dollar. Every currency pair is a bit different. Okay, and in these cases that we had moves out of the range, how many pips did the pair stray away from the range? What was the average? What was the maximum deviation? Was it deviation of 20 pips just a normal thing, or was it the maximum place the pair went to? Okay, ask yourself these questions. Asking these questions allow you to know the currency pair better and to learn what you can do. And because here are the sort of examples I found recently on euro dollar, is that sometimes, well, you see your euro dollar moving to a lower low and immediately moving to a higher high, but it still didn't move out of the range, right? Eventually, that arrow on the bottom is where euro dollar moved out of the range, okay? So these examinations, these observations help you find the place. You can do it just running back on the charts, using your eyes, using statistics, the way you prefer it. Try to understand how a currency pair works in this method of backtesting. At least I know many of you are relatively new. Just examining the charts without trading, that's the best thing you can do. Now, okay, in a perfect world, I would say if you can put your stop loss points 15 pips above the maximum deviation in most currency pairs, that would be the best options. Okay, so you're maintaining a safe distance from the maximum place the currency pair hit. But we're operating in a normal, in a perfect world. Maybe the maximum deviation would also be okay. Okay, so try to find that perfect place. Maybe it won't be perfect, but the one that works best for you. Now let's look at. I mean, there are lots of. Here I have all the time frames that are available on the FX chart. I wouldn't look at all of them. I would focus, I mean, on 5, 15 minute, 1 hour, 4 hour, 1 day, 1 week, and try to zoom out. Go back 3 big time frames like these ones to get enough data. So if you're trading on the 15-minute chart, go to the 4 hour or the daily and try to examine which moves are real breakouts out of the range and which aren't. Okay, that'll help you find where to put the stop loss. And note extreme events such as non-farm payrolls. We have crazy volatility at some points, but it's only one-time event. So you can, one way is to exclude these events, but next time you trade, don't trade around these events, or look for these events, only these events, focus only on them, and refrain from other kinds of from quieter times. Okay, so because these things are different. Fake outs are common. Fake outs is when you have a break out of the range, but nothing materializes. But in many cases, they can turn into opportunities to trade the pair back into the existing range. Okay, so you just these are, I mean, I guess in many forex courses you're told about looking for the big breakouts, buy high, sell higher, sell short, cover lower. But in many cases, the best opportunities are those mean reversion ones. Okay. So what consists of a breakout? Sometimes we do have a fake out, which is just the probing, just the first attempt before making the bigger move. Okay, so we can just be more alert, see when we have this kind of 5 pip deviation from the range and we are looking for that breakout, the next move will already be 50 pips. Okay, so look out for these things as well. And in any case, let's say you've backtested, you found your perfect stop loss point, 15 pips out of the range in your dollar, just an example. Wait a bit longer. Don't jump into markets immediately. I would suggest first front testing it. I mean, not looking at the past, but observing the future, operating on a demo account. So I think it's good advice in any case. Just if you've developed something new based on backtesting, front test it first on a demo account. Okay. You can test more than one pair at a time. I would say 3 maximum. Don't exaggerate, and I would stick to ones that have a lot of volume. Like I mean, currency is a lot of volume. Here we have dollar, the euro, pound, Aussie, Kiwi, Canadian dollar, yen, and the Swiss franc. There's lots of action over there, especially when it involves the dollar. Of course, I think it's 86 or 87% of total forex trading is with the US dollar. One side of the pair is the US dollar. So when we have more volume, we have more market logic. Things tend to behave more in a more rational manner. There's no problem testing again 3 pairs. You can still remain concentrated, and you don't have your own real money on the line, right? It's a demo account, so there's no risk. You'll lose maybe a bit of concentration, but not that much. Okay, and now you can, after you see that it works well for you, you put the stop loss at the right point. In most of your trades, you either have a good risk-reward ratio, and most of your trades are winning, so the strategy is profitable. Now you can trade with your regular account, which is, of course, nothing works perfectly well as in the demo account. And again, don't blame the broker for that. Just test your conclusions with smaller trade size that you would be doing otherwise, because this is the real thing, the real test, not the demo account. So if you start small and think big, you'll eventually make it. And yeah, and once you have something that works for you, keep using it. If it works, don't fix it, right? But if it stops working, and things stop working all the time in markets because correlations change all the time, the market mood changes all the time, volatility changes all the time. We see it right now. Yeah, I mean, we didn't have this kind of volatility 2 months ago, right? So it's time to get back to the drawing board and try things once again and try to find that stop loss once again. Okay. Yeah, let's move to the next part. Maybe I'll do a short pause here for questions if you have any about the stop loss. About my idea here is to try to help you develop your own tools to find the stop loss by examination, back testing, and front testing with small size. Not giving you a winning strategy because things change all the time and I don't know it. Okay, I see no immediate questions. You can of course ask me later. Let's jump to how to exit a trade. Talking to many of you guys, we've learned that exiting a trade can be very, very painful. Jumping into a trade can be always easier. You feel you have a hunch, you jump into a trade, and then it's a bit harder to exit. Yeah, we have a question here from, well, before we jump into that, can we use average true value as an indication for stop loss? Yeah, yeah. What you're asking is a bit more advanced. I guess you have more experience, but yeah, if you use the average true value as an indicator for your stop loss, if it works for you, it works for you. Again, the main message here, backtest it on your currency pair, zoom out to see if it really works, front test it then with the demo account, and then go ahead with the real account and with the smaller trade size. I would say that for beginners, it's worth gluing your nose to the screen in the testing phase, not when you have an open trade, and having a feel for the currency pairs. Yes, you can then try this kind of indicator. You can try all kinds of volatility ones. You can try looking at simple moving averages, which I'm a fan of. But again, each person with her own message. Can I update my stop loss after reanalysis? You mean on an open trade? We'll talk about that very shortly. That's an open door. Yeah, which time frame is good to enter, exit the trade? Lower time frame, higher time frame? Okay, great questions. In general, I think higher time frames are better because we have much less noise. Have much more noise in the 5-minute chart. Lots of false signals, lots of overbought, oversold stuff, and of course, the higher you go and the bigger picture, you get cleaner trades. You have trend lines from 2015 becoming relevant in euro dollar, but on the weekly chart, of course, things like that. And if you use time frames which are gone too far, then I think you won't find any trade opportunities, and it'll be a bit, and you'll lose your patience much earlier. I mean, it's not useful. So I would say a 4-hour chart is a good one. But I would say stick to the same charts for entering and exiting the trade. For analyzing before the trade, you can zoom out a bit to see the bigger picture. Always trade with a friend and make the trend your friend. Better trade with a trend than against it. But so that's why the big picture helps. But once you're in a trade, stick to the same chart. Now, update my stop loss after the analysis. We're going to talk about that right now. So, exiting a trade. First of all, the case in which not to move anything. If you have a robust, well-tested system, your stop loss point, your take profit point, they will exit the trade for you. So just sit back, okay? Don't do anything. It's not because I'm lazy. Well, maybe I am, but in any case, the system is built on a win rate ratio and also on risk reward ratios, okay? So if you have a system that wins even, let's say, just 40% of the time, but your risk reward ratio is 5 to 1, so each winning trade gets you 5 times more money than your losses. Stick to that, and it works well. So don't move anything, because once you move things, you'll break these figures. You'll break the risk reward ratio. You'll break the win rates, and you won't follow the plan. Okay, so if you have a good plan that you're confident of, back tested, front tested, don't move anything. Okay. So if you're still unsure, let's talk about, you're still testing. You're not sure about where to put the stop loss point, not sure about where to put the take profit point, then I would say if you're in a profit and you want to minimize losses, if you just want to be safe, and we've been talking to some people who just don't want to lose money, prefer having a high win rate and a smaller risk reward ratio, but that makes you feel more confident, just move your stop loss to break even. Now, don't forget to take costs into account. So there's the broker spread, sometimes fees, sometimes commissions. Just calculate that, okay? So it might be, I don't know, that means to break even you would need a 2 pip spread or 3 pip, okay? So just take that into account. Okay, so that's if you want to want a higher win rate. Now, if you have if you're still testing and you're not sure about the stop loss points and take profit, then if you want some peace of mind, exit the trade at a profit. First time you see a profit, cash it in. You'll be happy to win, not only break even. But then profit size depends on when you look at the screen. So you might make more profits than just moving the stop loss point to break even, okay? And it'll be more time consuming. You'll have your nose glued to the screen at the wrong time. You want your nose glued to the screen and fully concentrated when analyzing. You don't want to be sort of in a loop when you have an open trade, because then if your trade is losing, you'll get nervous and frustrated. And if your trade is winning, should I exit now? Maybe not, maybe yes, maybe no. So you won't be very sure of that. In any case, even if you've exited your trade early, it didn't hit the stop loss point, it didn't hit take profit, you decided it's not for you, and you left the trade with small loss. You said it's not for you, but you already made enough profit. You don't want the full take profit. Sure, okay, you're still testing. That's great. What I recommend is keep following the trade. What would have happened had you not exited the trade? Now you're much calmer. Now you can follow the chart without being too anxious. Would it have reached your stop loss point? So if it would have hit your stop loss point, is this trade still compatible with the winning strategy? Would it be one of those trades that would have lost? And it's okay because you have enough winning trades, a high risk reward ratio. The one-off loss is okay, keep going. Nothing to change here. But if you have a series of losses, either theoretical or not, it's time to go back to the drawing board and look for to try to improve your system, try to improve your stop loss point. Okay. And the same thing goes for theoretical take profit, okay? Keep following the trade after you've exited it early. Would it have reached the take profit point? Yeah, yes or no? If it did so, is it a rare win? Was it just luck? Maybe something extraordinary happened in markets and it went in your direction and you left your trade a bit early. Maybe you missed out, but would have, could have, should have, didn't. That's my answer, as this image shows here. Be confident, another opportunity will come. You weren't confident enough in the first trade, another one will come shortly. So again, keep following the trade. Now here, so these are my advices. Getting back to your question about updating my stop loss after analysis. But in any case, do not deepen the stop loss. That means after you've analyzed your trade, entered a position, got into your trade, don't widen the stop loss. Say it's going to about to hit your stop loss, you're about to lose money. Don't push it even lower. Don't deepen it. I would say the same thing goes. I mean, if you do move the stop loss, move it towards a smaller loss. And in that case, you can also consider deepening the take profit, making your take profit more ambitious. So all your trades moved in the direction that the market is going. You minimized your losses. You increased, in case it hits your take profit, you increased the number of pips. So you can either, in any case, what I'm saying is, if you move your stop loss, it's only in one direction, minimizing your losses, okay? Only minimize losses and maximize profits. Okay, before we move to a few bonus tips and questions, well, let's answer questions we have now. How to identify demand and supply. I'm not sure I understand the question. Demand and supply. Some traders works better in stocks when you know order book, you know where trades are positioned, how strong is demand, how strong is supply. But in Forex, what is more relevant is, well, for me, support and resistance lines. If um, um, some point wasn't reached for a very long time, it means it's a stronger resistance line. If it's been hit twice, a double top, a double bottom, then it's a stronger line. It means more positions are centered around there, and it's a fierce one. In this case of resistance, there's more supply, more selling. In case of a support line, there's more demand. I don't know if I've answered your question. Yeah, another question here. How is AutoChartist? Is it reliable for signals? How to get the right signals? Well, what I'm talking about here in this presentation is developing your own system and not relying on signals. Personally, I've only small familiarity with AutoChartist, so I'd rather not provide, a full opinion. Yeah, I think it's better to develop your own systems. Okay, welcome to ask more questions. Yeah, let me continue with the bonus tips. Oh, we're running out of time. We'll push it a bit longer. So let's talk about bonus tips quickly. Don't risk more than 2% of your account, 2% rule. Otherwise, you'll lose the lesson. Okay, so if you lose, always have more money in your account the money that you can afford to lose, and that way you'll have more time to practice. And worst case scenario, go back to your demo account. But if you lose big chunks of money, you'll liquidate your account. You'll not only lose your money, you'll lose the lesson. So first learn to lose. The wins will come later. Your charts, 3 indicators is more than enough. I know there are many, well, according to the questions, I see some people here have quite a bit of experience. So with more, you think if you have more indicators, your system is more robust. I disagree. You'll just get more confused. Your chart can become very pretty, but useless. We want to be successful and profitable, not have pretty charts. There's always more. Yes, euro dollar is the majority of volume in trades. It's fascinating, but look, it's 27 countries, hard to trade. 27 countries in the Eurozone. The world's reserve currency, on the other hand, I would recommend taking a look again, examining the Australian dollar against the US dollar. The Aussie, I think the technicals there work much better with trend lines, with support and resistance, with respecting old lines. Not always, nothing is perfect, markets are changing, but I would suggest checking that out. And if you look to trade the news, I would recommend trading Canadian events, dollar CAD. I know most of you overlook this currency pair, but I think it's quite it's worth it. If you use RSI or other things to look at oversold, overbought conditions, sometimes extreme situations are totally justified. So even if the chart says oversold or overbought, it's okay. It makes sense. Something extreme happened. We're living in extreme times. We had COVID and a war in a span of 2 years. So not everything is in the price. If it looks oversold and overbought, maybe there's a good reason for that. So markets can remain irrational longer than you can stay solvent. That was John Maynard Keynes, one of the most famous economists, said that. So I would listen to, or at least that quote is attributed to him. Okay, many like, I think I already mentioned that, but many of you like breakouts. They're more exciting, but they can also result in a heartbreak. So currency pairs tend to revert to the mean. It can be boring, but quite effective. So buying at the bottom of the range, selling at the top, not exactly the bottom, not exactly the top, but think of it that many currency pairs, during many periods, they tend to cling to the very middle. Okay, so that's something to take into account. Maybe that can be more profitable than trying to find these big, exciting breakouts. Okay, and yeah, go with your gut. But so we all have hunches. We all have sort of gut feelings. We think something makes sense to us. I encourage that. That's great. Intuition is a good thing. If you have a hunch for a trade, it's worth exploring, but please test it. Back test, front test, and don't jump into a trade before you're fully convinced. So have a hunch, test it. Okay? And yeah, and I think I also mentioned this before, always analyze your winning trades. You have it at least more organized. If it was a well-executed plan, celebrate it. Okay, you did well. You can have confidence that your next trade will work even better. If it was pure luck, okay, if you had a winning trade, but now you realize it really wasn't wasn't you. It was some kind of lucky charm. Come down from your euphoria. You're not invincible. You can become too euphoric and then lose the next trade. And just analyzing both winning trades and losing trades balances out things. Means you'll be with a cooler mind, and you'll have less ruminations. You'll be pondering less on those losing trades. At least you'll have things a bit more balanced, less of that would have, could have, should have. So yeah, yeah. So that's my advice to you guys. Let me. Yeah, well, you're welcome to ask more questions. Let me once again, for those of you who are still not premium subscribers, let me invite you to our premium service. You can click on the link here in the chat box. It's in the chat box, not in the Q&A one. I see more questions that are not related to this presentation, and I have a few more minutes to answer them. You're welcome to ask more about the presentation, about other things. Question that I see here is about US inflation tomorrow. So back from an educational topic to what's happening in markets right now. So it's a very, very sensitive event. The Fed is focused on inflation, not employment. So inflation is important. Core inflation is more important because that's what the Fed can control. Demand control, sorry, not control, impact. It can't control global oil prices. It can't control supply chain issues in China, but it can impact a lot. Demand. If interest rates are higher, people tend to save money and they take out fewer loans. Okay, so it can cool demand with interest rates. Lower demand, lower inflation. That's the idea. That's why inflation is important. Core inflation is important. We've seen salaries rise a lot in the US, 5.5%, if I'm not mistaken. Core inflation is currently annual at 6.5%, so real income is being eroded. It's going to come down a lot tomorrow, okay? Because it's yearly. Core CPI means we're getting data from April 2022, but annually we're losing April 2021. April 2021 was a huge figure, 0.9%. We're going to have a fall in core CPI. It's not what matters this time. What matters this time is core CPI. What we see on the calendar is 0.4%. My personal bet, and I may be right, I may be wrong, is that it'll be 0.4%, which is still strong, and that means interest rates are going to rise as the Fed planned, or even more, and that's good for the dollar. I mean, maintaining the dollar positive trend. The other scenario, I mean, this is a high probability scenario. The medium probability, but absolutely possible, is another miss. Last time we had 0.3, we could have 0.3 once again. In that case, we'll begin seeing headlines peak inflation, US inflation has peaked. Maybe the Fed will not raise rates so quickly in the dollar. I think we'll see a big correction. So only 0.1%, and I think we'll have a big reaction. We also have the other side, the 0.5%. I think it's a low probability scenario, but in that case, the dollar is going to surge because markets are going to bet on a 75 basis point hike next time. Currently, markets are betting more on a 50 basis point hike, but what Fed Chair Jerome Powell told us. So yeah, you asked about inflation. It's my answer. Well, long answer, but well, sort of a not so quick preview. Trailing stop losses. I think it's a bit more of an advanced thing. I would begin with again finding examining, backtesting, front testing, getting a good system, and then not moving your stop losses. And in general, yeah, you can use trailing stop losses, but again, preferably move the stop loss only in the direction of the winning trade. 2%, 2.5%. The final rate. Yeah, dollar index. Yeah, well, I see another question about the presentation. I'll answer that first. How to trade the range of tops and bottoms are not often precise. Yeah, these can be tough, finding the top and the bottom. I would say stick to the middle. They're not always precise. Again, we talked about finding where the deviation is significant and where it isn't. But if you cling to a smaller portion of the range trade and you see currency pair moving up from the bottom of that more limited range, then there's a better chance that that your long position will be more successful. So again, limiting risk is the key. And yeah, looking for things that are trading in a range that is clear make things easier. If not, you can always jump to another currency pair. So don't get stuck on one currency pair. More questions here. Yeah, about pound dollar. Pound dollar. Yeah, I think it's in general heading lower. Very gloomy forecasts by the Bank of England. Retail sales are falling in the UK. So we're already seeing some kind of stagflation there. It's not happening in the US. I think Bank of England has maybe 50 basis points left for rate hikes, and the Fed has 150 or so. And yeah, I think we have more certainty in relative terms about the Bank of England, less so about the dollar. Once the Fed says, okay, we've reached peak inflation, we're still going to raise rates a bit more, but sort of seeing the top of the mountain, then the dollar is going to fall, and we're not there yet. So I still see US dollar rising and pound dollar falling. The same goes for the Kiwi dollar. Yeah, euro dollar, euro against the Aussie. I think the Aussie has some more room to gain against Kiwi. The economy there is doing better. But the scare about COVID in China currently is hitting the Australian dollar. At some point, maybe there's more room for falls until the ECB announces its decisions. But in general, I see the trend. Sorry, more room for rises until the ECB makes its decision. Lots of uncertainty. General uncertainty helps a currency pair. A specific currency. So there's less certainty about the euro. That means euro can rise in the short term, but in general, Australia is doing much better. So that's a quick question. WTI stabilizes in low hundreds after Monday's dump. I see that question in the Q&A section. As the EU means, yeah, the EU, there's a delay with EU's negotiations, internal negotiations, especially between Brussels, the EU and Hungary. And that's negative for oil. More European imports of Russian oil is bad for oil prices. At the moment, with all the uncertainty about demand, I think oil has room to fall. In general, high oil prices mean less money in people's pockets for everything else. So that means slowdown for the global economy, and slowdown for the global economy. Expectations of slowdown mean lower oil prices in general. The market mood is relatively gloomy. I don't buy the current recovery. I think it's bear market recovery. I mean, in stocks. More questions here. Yeah, so I see the dollar index and dollar in general rising. Okay, did my best to answer your questions as fast as I could. We're already overextending our time. But in general, I once again want to invite everybody who is not in the premium, subscribe to premium, to sign up. The link, I'll put the link once again, doing my pitch. Yeah, so you're welcome to sign up. I get much closer access to my thoughts, to the smart thoughts of my colleague Tomas Sayes. He's excellent in technical analysis. I'm sure he has lots to say about psychology, stop loss, and other things. Can tap into his wisdom, tap into my knowledge of markets, and well, we have lots more over there. So if you're not a subscriber, please join in. Thank you very much, everybody, for joining today. I hope you've learned something, give you a bit of tools to improve your system and become better, more confident traders. That's it for today. I think my next webinar will be in around 2 weeks' time. But again, on the Discord channel for premium subscribers, I'm very, very accessible, as those of you know and can testify. So yeah, thank you very much, everybody, for attending this webinar. You'll be able to see a recording of it, everybody. The recording will be open to the public, so you can see it once again. Fast forward, rewind, whatever you wish. Yeah, thank you. It'll be available yeah, later today. Okay, so already today. Okay, I think I've spoken, yeah, overextended my time. But anyway, hope always like answering questions, and I hope this helps. Thank you for the kind words, everybody. And so that's it for today. Thank you, Slobodan. We know each other. And yeah, well, hope to watch your upcoming preview. You'll have access to Slobodan's premium webinars as well. And he's a great educator and knows a lot about markets and encyclopedia of knowledge. So, okay, that's it for today. Thank you very much once again. Hope to see you soon. And bye-bye.